Hello, I'm Turi Condon, Property Editor of The Australian, and with me today is Cameron Kusher from RP Data, and we're talking about their latest housing figures. So Cameron, we've seen a bit of a slowdown. Do you think that this is the beginning of that trend?
It's a little bit difficult to know. The September figures showed that values increased by 0.1%. If you have a look at the daily figures, they actually showed for the first 2 weeks values were falling over the month, and they started to pick up over the second half of the month. I do think that we're going to see lower levels of capital growth than we were seeing earlier this year, and even perhaps at the same time last year. But I do think we'll still see some growth happening in the market.
Are vendors taking advantage of the high pricing? Is there more stock coming into the market now?
Well, every spring we see a pickup in the amount of stock entering the market, but both new listings and total listings are now lower than they were at the same time last year. So we're not getting as big of an influx of new stock entering the market now as we were last year. But keep in mind as well, when we look back at sales volumes, they peaked in about November of last year, and we've been seeing a bit of a tapering off of sales activity throughout this year. Of course, our data's not yet up to September, and spring will be the real litmus test for the market. But I do think we're not going to see quite as strong level of sales activity this year as we did last year.
The one thing I notice your figures are showing, though, is Sydney is still quite strong compared to the other capitals. How do you see that playing out?
Well, that's exactly right. If we look on an annual basis, property values in Sydney are up 14%, and then the next best performer is Melbourne, where values are up just over 8%. So you're seeing quite a divergence there between the performance of Sydney and the rest of the market.
And even on the monthly figures?
Even on the monthly figures, we saw 0.8% growth in Sydney, and we saw a number of other capital cities actually recording a fall. I think this is, it'd be encouraged that the rate of growth is slowing from its peak, but obviously 14.8% over the last year, coupled with the previous year and a half of growth that we saw in Sydney prior to that, I don't think it's any real wonder that the Reserve Bank is starting to take a closer look at what's happening in the Sydney and Melbourne housing markets.
Very difficult to manipulate Sydney and Melbourne and not damage the rest of the country. Do you think the Reserve Bank will take any action with the macro-prudential tools?
Well, obviously there was a big lot of jawboning in the Financial Stability Review last week. They did, not as heavy, but they did point out these risks 6 months ago in that review as well. I don't think it's just jawboning. I think they are very serious about how much investor activity is happening in these markets, particularly because it tends to be very much focused on units in the inner city areas of both of those cities. But as you said, you're not going to have one set of rules for Sydney and Melbourne and a different set of rules for the rest of the country. Most other capital cities aren't seeing particularly strong growth, and they want to be very careful not to damage this big pipeline of residential approvals we've got as well. Obviously, the Reserve Bank has stated that they want to see residential construction take over from mining construction. There's a very strong pipeline there, but they'll ultimately want to see those projects completed. So it's going to be a very big test for them. They're going to have to be very careful as to what and how they implement any macro-prudential measures. Do
you think interest rates might actually take over and move before they have to do anything?
I don't think so. Obviously, if you're looking from a housing market perspective, you'd say we probably need higher interest rates, but I think there's a lot of other economic factors to consider as well. And I think the reason they're talking about macro-prudential tools is because they don't want to lift interest rates. We've seen Glenn Stevens very reluctant to think about implementing them in the past. Obviously, the Financial Stability Reviews changed that a little bit, and I think they probably realise that we need the low interest rates, and we can't use that to curtail what's happening in the housing market. We need to look at other measures.
And there's been a lot of debate on negative gearing. Do you see the government touching that?
I don't think that's going to happen. I think obviously a lot of people are negatively geared, and I think politically that's not going to be a winner for anyone. So I don't see any change to negative gearing at this point in time.
And a final question, if you're an investor now, given that the market's so strong for investors, or they're very interested in the housing market, where would you buy? Obviously Sydney and Melbourne have become very hot.
Well, Sydney and Melbourne, I think, as you said, we've seen very strong growth over the last 2.5 years. We've seen a lot of new development taking place, and we're seeing rental yields which are extremely low. And I think a lot of investors are just looking at that capital growth at the moment. I think wherever you look, you're not going to get that same level of capital growth repeated, but I think there's better opportunities outside of those markets, perhaps in a market like Brisbane, where we're starting to see some capital growth. And maybe if you're looking for the longer term, there are some opportunities in some of the regional markets located close to the capital cities, areas like Newcastle, Illawarra, like Sunshine Coast, Gold Coast, where we're finally starting to see some capital growth coming back into those markets. Rental returns are relatively strong, and obviously prices have fallen quite a lot over the last few years.
All right, Cameron, thank you for your time.
Thank you.